Hello, welcome everybody. Thank you for attending our client conference that we have. I'm trying to have it every year. It's been like 2 or 3 years. COVID has made things different, but at the same time, it's helped us out. You know, God is good all the time. So when you think you get something bad happened, it really just helps you out in the long run. So this is one of those things where COVID kind of forced us to go online and had the client conferences virtually. We used to have them before
in
person, right?
In different times.
In different times. And you know,
no, different towns.
Different towns?
We went to Atlanta.
Yes.
We went to Atlanta. We went to New Jersey conference, and we were about to do New York.
That's true. Yeah. So we were going to different places and doing those conferences. So this virtual one definitely helps us out because we can get all clients, because we have clients in the West Coast, East Coast, down south, Canada, in different overseas. So it helps us a great deal with allowing us to really reach out to our clients. So welcome to the 2022 tax seminar, where we're going to go over a lot of things. It's basically letting you know how it's going to operate for this new tax year. So happy New Year to everyone that is there. I hope you had a blessed New Year. You got anything to say?
Yeah, happy New Year, man. I love this New Year. I love how it's going. So far, I had to shovel snow. So continue going New Year.
Well, you know, the Farmer's Almanac says it's going to be the worst winter.
The worst winter?
That's what they say. So we'll see how it goes. If you have a problem hearing, or if there's anything, you know, drop us something in the chat. But I think we tested everything and we're good to go. So here we go. All right, so this is the 2022 tax season tax law from Fraser CPA Taxco. I have to put this disclaimer out. And the reason why we put the disclaimer is because we are going to be publishing this on YouTube. So there are going to be other individuals, clients that couldn't make it, people who are not clients that are going to read and see this information. And this is not going to be considered tax advice for those individuals. So we have to put that disclaimer out. This is just communication. So we can't cover it all. You know, we're trying not to bore you. We're not boring people, as you know. Like, we are always lively. We're always making jokes. So we're full of life. So we can't cover it all. And a wise man says, "You never know it all. Only a fool knows it all." And what happened?
Yeah, no,
this is true. It's only a fool knows it all. So we're just gonna give you as much information in this small amount of time. It's gonna go pretty quickly. So I love that African proverb. So the 2023 tax season is going to be very, very important tax season. It is going to be a pivotal tax season for a lot of individuals because things are changing. So the only way the government gets money, or I wouldn't say the only way, but the largest source of income for the United States of America is taxes. It's income taxes, payroll taxes, corporate taxes. But if you look at this chart, individuals, people like me and you, are the ones that are basically funding the United States of America. So taxes are very important, and it is the lifeblood of how America operates. So the reason why 2023 is so important is the government right now, which what's that thing when they had to vote on the Speaker of the House?
Yes,
they don't know what's going on. They're all over the place, and the only way the government makes that money, like once again, is taxes. So they either have to spend less, tax more, grow the economy, or use a combination of those three. So that's why this tax season is so important, because we know they may not be spending less. When you take a look at 2022, the government brought in about $4.9 trillion. Sounds like a lot of money. And it is a lot of money. But at the same time, we spent $6.27 trillion. Now, if you know math, 6 is bigger than 4. So we have a deficit of 1.38 trillion. And the reason that's important is because the debt ceiling is very important. Actually, today, they announced that we have reached our debt ceiling. So the government has to make a decision. Either are they going to increase the debt ceiling, or they're going to increase taxes, or they're going to reduce spending. Something has to come on or make a decision to do that, because if not, if the government shuts down, Social Security will be affected. Credit card interest rates would be affected. So this tax season is big, because when we look at GDP, the amount of goods and services that we do, after COVID, it dropped. It dropped completely and it went back up. But then in 2021, it was up and down. But in 2022, the economy started to slow down. The third quarter of 2022 was pretty good. Fourth quarter didn't come out yet. So we don't know what 2023 is going to hold. And taxes are very important, because this is how the government collects money. This is how we fund the government. So this is going to be a collection year for the government. And if they collect less than they anticipate, it could affect us a great deal. The tax season is going to start this Monday, January 23rd, 2023. Taxpayers who have children, we expect delays in the refund.
Let's pick a point here. Tax season starts January 2023. And 2023. That means the start of the e-filing. And there might be clients who have some returns that we did not e-file between the months of November and now. So those returns going to get filed on the 23rd, once that e-filing period starts.
That's a good point. So we do have the opportunity to file 2020s, 2021s, and 2022.
2019 would have to be going in the mail.
We have to paper mail it. So this is one of the first year where the IRS is actually giving us a chart. In the past, I think when's the last time we saw a chart?
It is a long time ago. The last time we saw a chart was probably about 8 years ago.
Yeah, I think that's true. So this chart kind of gives us an idea. It's not exact, but it gives us an idea of if you file by X date, you may get the refund by Y date. And if you look at it, if you do not have a child, of course, you get the refund a little faster. But if you do have a child, it delays it. And the reason why, the government has to do their due diligence. They have to make sure that you can qualify for the child tax credit. You have to qualify yourself if you are eligible for the earned income credit. Any money that the government's going to give you that you didn't earn, they're going to have to do their due diligence. In addition to that, the items in the red that you see are what's called peak seasons. In those peak seasons, the refunds are going to be delayed. So the reason we show you this is that, once the return is e-filed and accepted, it takes some time for them to process the refund. The best thing to do is to go to the IRS online website, click Where's My Refund. Even if you go to our website, we have a link there that says, Where's My Refund? It will take you to this. And as you can see that we circled, the IRS has already started to give you the opportunity to check on your 2022 tax return. You could check on 2022, 2021, and 2020, like we indicated. You put your social security number in there, your filing status, the refund amount, and it's like tracking a package. It will let you know if they've received it, if they're processing it, and how fast you're getting it. Now, the funny thing about the government is a hurry up and wait. You hurry up and file, then you have to wait. And I know sometimes it could be frustrating, especially coming off from Christmas. I know I got 2 kids. You probably spent a little bit more than you expected. The holidays are fun. You want to enjoy it. So some people have already maybe accounted for that money, and don't spend money you don't have in this instance, meaning that if your refund is going to be $5,000, just wait for the money to come, because it is not granted until it's in your bank account. And I think that's another good point. Direct deposit is the best thing to do. Once COVID happened, we realized mail moves slow, it can be lost. Direct deposit is quick, it's fast, and it's easy. So if your banking information has changed, please let us know. If you want to put it into a savings account, any changes in banking, definitely let us know, because if it goes out and we have the wrong banking information, it's incredibly hard to fix. I think we can't even fix it sometimes.
Can't fix it.
Yeah, we can't fix it.
You gotta wait and you'll get a check.
Correct.
If the bank account is wrong or if your bank account closed. So it's imperative that you complete that annual data form. I think we're gonna touch on it a little bit.
Yeah.
But let's just touch on it now. Your annual data form, which is if there's any change in your situation, indicate it on the annual data form. How simple it may be, it may affect your refund, may affect where your money goes and all of that good stuff. So
yeah, the annual data form is for us, and we make a lot of analytical decisions off of that. If we see that you checked off a box that your address changed, we want to know about that, because of course we have to update your address. But did you also change jobs? Where did you move to? Did you move out of state?
did you buy a house?
Did you buy a house?
All that.
Did you sell a house? So those little things on your side have a repercussion to us on our side, because when we go through our review, we take those things into consideration when we're doing the review. So those forms, even though there's some people that come in and say, I filled this form out, it's the same thing you asked me last year. And
every year, it doesn't change.
It doesn't change. It's the same questions. Yeah, but you know what? You're right. It is the same questions, but with every year, something have changed with you, and we don't know. We're not living with you. We don't know what's happening in your life. So that form really helps us out a great deal. So 2022 tax season, the refunds are going to be lower. I'm going to rip the Band-Aid off right now. It's going to be drastically lower. When Trump won the presidential election, he made drastic changes to the tax law. Those changes were really focused on business owners. It was not focused on individuals. A lot of the individual deductions were scraped away. Things were just lower. As you can see, when Trump came into office, the refunds started to go down. And in 2019, it went down even further. And it would have kept on going down if it wasn't for COVID. COVID gave us a lot of these additional incentives that allowed the refunds to be higher to help stimulate the economy. And we saw that in that chart that we showed you with GDP, because people were spending, we're bringing up the economy. And as you can see in 2022, it's going to be lower. We're expecting maybe a 23% drop in refunds. And that drop is going to have an effect on your taxes. And we know it because we know we're going back into the future to around 2019, and we're going to see how it's going to affect us. The IRS already knows this is going to be an issue. In November 2022, they issued out this bulletin, and they indicated, we already know that there's going to be a significant reduction in refunds moving forward. And the reason why is there will be a lot of credits and stimuluses that we put into place that are not going to be there anymore. So there's going to be 4 issues that are going to make your refund look really small coming into the tax season. A lower child tax credit, a lower child and dependent care credit, lower earned income credit, and no recovery credit. And we're going to go through each one of those so you can just understand what that really means. So the child tax credit, in 2021, we were receiving $3,600 to $3,000 per child, depending on the age. They even prepaid us that money through the year to once again stimulate the economy, raise GDP. They want to make the economy go a little faster. And like you said before in that chart, we saw that 2021, 2022, we're starting to go down a little bit. We're not going to have that. The child tax credit has reverted back to the 2019 levels of $2,000 per child. And once that child is over 17, it drops to $500. And that age
It's
17
is a key age, and you got to look when that child reaches 17.
Mhm.
It's a key factor, and you might see a big drop in your refund once that child jump over to 17. So talk about that a little bit for them.
And it doesn't matter when the child turns 17. Doesn't matter if they turn 17 in the summer, the fall, the spring. If they are 17 by the end of the year, December 31st of that year, they're considered 17 for the whole year. So, I'm a December baby. I'm a December 7th. So, if I turned 17, I know my parents would have been like, what's going on?
Yeah.
He was only 17 for maybe 28 days. Why are you taking all this away? But that's just how the tax law works. The credit won't be 100% refundable. Last year, we could have got the whole $3,000 refundable, the whole $3,600 refundable per child. We can only get a $1,500 of that is going to be refundable. There's an income requirement. In the past, you didn't have to have any income, or we could have used your 2019's income. That no longer exists. We do not have the ability to use those different tax laws to stimulate the refund to make it higher than what it was.
Because that was all this COVID relief, COVID benefits that kicked in 2020 and 2021.
Yeah.
And they're gone for 2022.
They're gone for 2022. So the next thing was child and dependent care expenses. So I have 2 children, and my youngest Cooper was in childcare. And it's a mortgage. It's not cheap at all. It's very expensive. So what the government did last year is they allowed us to take $8,000 worth of those expenses for deduction to calculate the credit. So that helped a great deal, because if you had 2 kids, that was a large amount of money you could use for the credit. It's fallen back down to $3,000 per child. In addition to that, it's 35% of what you paid is the max, but most people are going to get 20%, and it's no longer 50%. And the benefit starts to get reduced. And once again, it is not refundable. So in the past, if you didn't have a tax, they would have refunded you that money inside your refund. And it helped out on the state side too, because the state of New Jersey also allows you to take some of that credit. And they were using what the federal was doing on New Jersey. That no longer exists. So that is the second thing that's going to make refunds drastically lower. The earned income credit. The earned income credit is a very big credit. It's the government giving you money. That earned income credit is going to basically change. Last year, it was expanded. The earned income credit used to have an age requirement. You either have to be 25 to 65. If you're between that, you can qualify for the earned income credit. In the prior years, they took away that and they said, hey, you can be 19. So younger individuals who were working smaller jobs could have not filed with their parents and received the higher refund. And we would have did the analysis and say, hey, listen, yeah, it's probably better that the child files by themselves, because the whole family in total would get a larger refund. That's not the case anymore. So, they got to talk to them.
You got to talk. You got to really talk to your child. And I cannot understand why some parents say, oh, your child filed. I don't know. No, you must know. You got to take control of your child's return, especially if they're living in a house. Take control of their return. Make sure that they don't file before you. Let's do an analysis on the return to see if that child is better suited on your return, or that child should file an independent return. Just don't wait till the child file and then you say, oh my God, and as you said, big suck teeth just come out.
Yeah, big suck teeth just come out.
And
But I mean, I think we still have that thing in place where if you bring the child's return, they're not over the standard deduction, we would have a reduced rate or even no rate for filing the return. So if you have a child, you can bring in their W-2s with yours we could file the return, and we could also be able to do the analysis to see what's in the best interest. But we kind of know moving forward, it may not be in the best interest. But the main thing is really have a conversation with your child who is working a job, because technology is totally different right now. They can file a return in less than 5 minutes, take a picture of their W-2, throw it up into Cash App is filing returns, Credit Karma is filing returns, the big box ones are filing returns all on the phone. So the younger generation has the ability to file way different than we had that ability, and they can do it in one click. So it's really good to have a conversation with them, because that's going to have an issue. The earning credit for childless workers, meaning that people who have no kids. It used to be $1,500. $1,000 got taken away to $500 in 2022. So, and we are unable to use your 2020-19's income. Last year, 2020 and 2021 returns, we could have looked at what income you had in 19, regardless if you didn't work or not, and use that to calculate this credit. We don't have the ability to do that anymore, reducing the refund. Recovery rebate. There was no fourth stimulus. We were all waiting for it. I know I was.
No stimulus.
No more stimulus. I mean, I would just say no more. We don't know because when the first stimulus came out with Obama, remember in 2008,
600,
the 600, people were loving it.
Which we doing? 2008 one, the first time home buyer credit?
No, Obama did a stimulus.
Okay.
Obama did a stimulus. I gotta go research it, but Obama
the $600.
The $600.
Yeah.
It was a stimulus, and we thought it was never going to happen again, and then boom, we got stimuluses again. So we can never say never, but there was no fourth stimulus check. And the reason why that's important is if your income was too high in, let's say, 2020 or 2019, you didn't get a stimulus, but then we could have used that credit on your return in the year to see if your income was lower. So we don't have that ability because no stimulus were issued in 2022 like it was in 2020 and 2021. So that's another issue, because we had a lot of seniors that were getting this additional one because they've only received one check and they didn't get the second check. So, that's going to affect it. So those are the 4 items that are going to really reduce the federal tax return for this tax season. And like we said before in the beginning, we're going to rip the Band-Aid off and let you know the refunds are going to be lower. We know they're going to be lower, and it's going to affect you because we are now going to revert back to the Trump era tax laws with no additional buffer on top of it.
We're saying that the refund's going to be lower, but we got to remember too, some people are going to pay higher taxes.
Yeah.
So we're saying, but the refund's going to be lower. True. But on the flip side, also, people are going to be paying more taxes for 2022.
Correct. Definitely. So it is what it is. There was another option that we had in the prior years where if you had a charitable donation, we could have took a small amount, $600 or $300 on the return, on the front of the return, rather than going on to a different page of the return where it was harder to get the benefit. Because I have people all the time that would come in and say, I've donated $6,000 to the church. If you don't own a property, and it's kind of hard for us to show you that on the return. It doesn't show anywhere. And I always tell them, if you're donating, you're doing that the goodness of your heart. You're not doing it for the tax benefit, but you probably won't see it on the return. So people who are tithing or making charitable donations, unfortunately, we may not see that benefit on the return if you don't own a property. And even if you do own a property, it may not come through depending on the amount you pay the mortgage, interest, and taxes.
Yeah, well, we just look at the standard deduction, 18,000 and 24,000 for a thing. You know, you got to be really giving a lot of money to charity,
correct,
for it to start to make a difference. So
correct. So that's off the table. Now, even though the unemployment.
No, before we go, because some people still remember. Some people still feel that some of these deductions still around, the miscellaneous deductions.
Yeah.
The miscellaneous deductions are no more. They're gone.
Yeah.
They're wiped out. So the nurses with the uniform, your shoes, and all of that stuff, don't bring those stuff. It's not
It's
there.
not in our form.
It's not on a form. It's not there no more.
Yeah.
So I just want to reiterate that part with the miscellaneous deductions, which people still feel, back to the old law. Some people still think credit card interest.
Oh, that's old. That's
Right.
90s. Yeah, so those things are not going to be there. Unemployment, there was no exclusion in the 2021 return, but some people still feel like, oh wait, I thought my unemployment wasn't going to be taxable. Certain states do not tax unemployment, like New Jersey, but it is going to be taxable on the federal side. So if you were receiving unemployment in 2022, we are going to see that full 100% tax liability on the federal side for that unemployment.
And for the unemployment, remember, especially in the state of New Jersey, they do not send you that 1099-G form. You're not going to see the 1099-G form coming in the mail.
Correct.
You have to log into your unemployment portal and request or print out that 1099-G for the unemployment, and you got to forward it to us.
That's a good point. It's a very good point. It's not coming in the mail. and what we don't want to happen is you receive a love letter from the IRS saying that, hey, you did not report this income. This is what it is, and you owe taxes. So, and that's something that we can't fix. Some people think we're magicians because we were able to fix a lot of things, but that's one thing. If I see it, I'll let you know. There's no way I can remedy this at all. So that brings us to a breaking point. I gave you a lot of bad news. I told you that the refunds are going to be lower. I told you about all these things that are coming out. So we have to take a look at our withholdings if we're a W-2 employee, which most people are. We have to look at those withholdings and make sure we're withholding the right amount. So when you come in to do your tax return, feel free to ask us, hey, should I change my withholdings? Should I up it for this new upcoming year? Because this upcoming year is going to be totally different than any other. And we'll help you out. It's fairly simple. There's not that much you're going to have to do. Just put your name, address, social, your filing status, and everything else you keep blank. We don't want anything else on there. But I know sometimes people don't want to do it. They want professional help. But we have to look at our withholding certificates this year. And one of the reasons we want to update the W-4 is there could have been a change in your filing status. You could have gotten divorced. You could have gotten separated. You've gotten married and you want to think about it. Now, most of the time, what do you say about marriage? Because I say if you're married, keep it single for the first year. What are you saying?
Well, if you're married, it depends. It depends. I look what the numbers say.
Okay. Yeah. So that's a perfect example. Look at what the numbers say. Like we said before, if your child turns 17, you want to change that W-4 because we're not going to get that child tax credit because in the government eyes, they're no longer considered a child. So that's $2,000. No, it's about $1,500 off of the return. You expect more income. If you believe you're going to be receiving more income or you got a job that's giving you better pay, you definitely have to update your W-4, especially if you're in the same job. Because even if you're in the same job, oh, you have a strong echo. Let me bring this microphone closer. Someone said there was a echo in there. I'm bringing the microphone closer. Hopefully that would help out. Thank you very much, Robert Hill, for letting us know about that. Hopefully it's better. But if you change your job and you're working at the same job, that job is not going to update the W-4 based on your information. So you have to go in there and do it. And then last but not least, you do not want more money from the government. You're saying, what is that about? What's more money? So if you've looked at your most recent paycheck, it's going to be about 7% higher. And the reason why is because they have changed a lot of the standard deductions and tax rates. Due to inflation, the government knows there's inflation, So they've changed the standard deduction. Usually the standard deduction goes up, by $100. Nothing crazy. We're seeing a $900 jump from 2022, which we're filing here in 2023. It's going to be $12,950 for single, to in 2023, when we file the return in 2024, it's going to be $13,850 for single. So that's a $900 jump. And then for married couples, it's an $1,800 jump. So we are seeing a little bit more money inside your paycheck. So if you don't want to take that money now and get the benefit later, you want to change your W-4. In addition, your paycheck will be higher because they have reduced the tax rates, not the actual tax rates, but the income brackets. So if you look at this chart, in 2022, if you made over $10,275, you're no longer in a 0%, you're in a 12%. But now in 2023, if you make under $11,000, you're still in a 10% bracket. So that's a 7% of your income will get saved because you'll be in a lower bracket. So those two mixtures will allow your paycheck to be higher. You may not see it, but if you take a look at your pay stub in January and your pay stub in December, it'll look like a small cent. It'll be like, if it may feel like $5, $10, $20. You're going to think nothing of it. But if we multiply that over 26 pay periods, you feel it inside that refund. And joint filers, that same 7%. So we definitely urge individuals to take a deep look at your W-4 for those things we indicated. And if you don't want this government increase, when we come and do your return, we can change your W-4 so you pay that increase back into the government and get it as a refund if you want to. It's up to you. The capital gain rates are going to also change. In 2023, you can make a little bit more money and pay a 0% capital gain rate. Capital gain happens if you sell a stock, you sell cryptocurrency, even if you sell, a property, you would get, or a rental property, you have a capital gain. So the capital gain rates, they have expanded the income that can go in there. So a married couple can have a taxable income of $89,000 and pay 0 capital gain tax, and a single person can make around $44,000 and have a 0 capital gains tax. And that's big, because if you're selling something, there's no tax to worry about on the federal side. There's still going to be an issue on the state of New Jersey side.
Yep. And then the capital gains go up to about 20%.
Yeah, so the capital gains, the max is still the 20%. And these are all Trump era changes that they made. These are things that are still been in place. Even though Trump is not in the office, his tax laws still live on. All right, so retirement has changed a great deal too. There were new laws that have been put into place. Biden signed a bill called, I think, Secure 2.0 in December. And that law allowed retirement to be a little bit different. If you are an employer and you have 10 or more employees, you're kind of forced to have a 401k. And if you're an employee, there are certain changes. I'm not going to go over all the changes, but the big highlights are, if you had a 529 for a child, which is a college savings plan, and that child didn't go to college or they didn't finish college, they don't want to do it anymore. In the past, you were stuck with that 529. You need to have to give it to a younger sibling. You go to school yourself, give it to a cousin. You have to use it for education. Whereas now we can roll that 529 into a Roth IRA tax-free, and it could be part of a retirement planning. So that's great news. You can move over $6,500 every year. There's a lifetime cap of $35,000. So if you had a child that didn't go into college, you had $35,000 left in that 529, you can make $6,500 increments into a Roth IRA tax-free. And this is a great way because it gives you the ability to save for college. And if you don't want to use that money for college, take it back out. So I thought that was a good thing that they were doing. In addition to that, the IRS or the government saw that consumer debt is going at an all-time high. We're talking about credit cards, vehicle loans, student loans. It is incredibly high. And we get calls almost every tax season, almost every month, saying, hey, I want to pull money out of my retirement because I have to pay for an emergency. I have to pay some things off. A family member died, or I am just in a tight spot. And we have to advise those clients that, hey, you're going to get taxed on it. You're going to get the income tax on it. You're going to get the state tax on it. You're also going to get a 10% penalty. So what the government's saying now, and starting in 2023, you can tap into your 401k before you're 59 and a half and avoid a 10% penalty. And the way they're doing was when you start contributing to your 401k, and I would suggest that you speak to your HR to make sure that this change is happening for you at your job. But when you contribute to your 401k, you can put a portion of it into an emergency savings fund. And then the rest of it can go to your 401k. Your employer makes a decision of how much that emergency fund can be. It's $1,000, $2,000. But when it's time for you to pull out, you can pull out from that emergency fund rather than pull out from your retirement fund. And I think that's great. You'd have to pay it over 3 years, but you're paying back yourself. And I think that's a great thing that they're doing.
Yeah, and to avoid that 10% penalty and all of that good stuff.
Yeah.
But you still got to pay the tax.
Still got to pay the tax.
Still got to pay the tax, but the issue here is that the 10% penalty is avoided, especially some people take out some little monies, here and there, emergency stuff. Now, you could avoid that 10% penalty. And a 10% penalty is a good chunk.
It's a good chunk. It's 10%. It's like giving it to God.
Yeah.
So there's bigger catch-ups for people who are over the age of 50. These catch-ups are going to be way larger. Even in 2024, savers between the age of 60 and 63 can either do their catch-up can be either 10,000.
This catch-up you're talking about is for the IRA, this IRA contribution catch-up. Roth IRA contribution.
Yeah, well, yeah, all the catch-ups.
Uh-huh.
So you can do it. So you either do the greater of 10,000 or 50% of whatever the annual amount is. I mean, this is forward thinking, but we don't want to let you know that these are things that are available to you as a employee, because the government knows that starting now in this 2023 tax season, things are going to be a little harder. And saving for retirement is up there on the list because they know that you have so many things. So they're making it easier for employers to allow you to save more. The only thing about this catch-up is that if you do the catch-up moving forward, it will go to your Roth. And what that means is you don't get a deduction for it on your wages, which kind of hurts you, but at the same time helps you, because when you take the money out when you retire, you don't have to pay taxes on it. And I think that's what the government's trying to do, trying to limit that. So that's the catch-up part of it. So that's the individual side of the thing. So as we can see, individuals, there's a lot of things that you have to take into consideration. We know that refunds are going to be lower, like you said before. Taxes are going to be a little higher. So those are going to be, that's the key takeaway from the individual side. On the business side, things are going to kind of be the same, because once again, even though Trump has left the office, his tax laws still exist. So a lot of those tax laws benefited business owners and real estate property owners. And one of those things is a 20% pass-through deduction. So it's an additional deduction. So if you're a business owner, we can take an additional 20% deduction of either what your net income is from the business or your taxable income, whichever is the lower of the two on the return. That still exists. So that's a good point. You can see that they're not taking away these business items. They're keeping those business items in play.
But I think if you're not in business, if you're not in business, it's time you start thinking of getting involved in some kind of business, because as Carlos was talking earlier, the individuals bear the burden of the tax, and the tax deductions that is coming out via your mortgage interest and all of those things are really negligible now and is gone. So the only other thing available for individuals is to play the same rules that the other people are playing, and make sure that you participate in the business so that you could gain some of these credits and benefits.
Yeah, that's definitely true. And just to piggyback off what you were saying is, if you are a person, you work a 9-to-5 job, you come home, when you come to do your taxes, we just have your W-2 to play with. Maybe you have a house and we can probably take the mortgage interest. The taxes are going to be capped at $10,000 because one of the Trump rules that they put in place. But if you open up a business, let's say you open up a gift shop, or I have a client that's doing gift baskets now. And let's say you did that. We now have the opportunity to take your mortgage interest, your property taxes, part of the utilities from your home, your transportation costs, all those costs in doing the business now get deductible. If that client went out to eat with her son and she talked about her business, that meal is tax deductible at 100% at that with these new tax law changes. So you can shift expenses that you're already paying. You're already paying the mortgage, you're already paying the property taxes, you're already paying your utilities, you're going to go out to eat with your son anyway. You get to make these business deductions, and that's the big thing. So and I definitely agree with you. Start a business. We're pushing it so much, and we're going to jump into that a little bit later. Employers, the IRS has warned employers about the employee and retention credit. I know some clients have called us and asked us to do it. We don't do that. We do income taxes, state taxes, sales taxes. We don't do this in payroll tax. This is a payroll tax type of feature. And what this basically is if you were a business owner and you had W-2 employees, you had the benefit of taking this credit. The credit still exists. Your payroll company or another company can amend your payroll taxes to allow you to get this credit. And it's around $26,000 per employee. It goes up and down based on how much you pay the employee, but there are qualifications. In 2020, your revenue drop had to be 50% or more. In 2021, 20% or more. Or there was something called limited commerce. And if your income didn't drop, but you had limited commerce, let's take, for example, you were a restaurant. You no longer could have people come into your restaurant in 2020 or part of 2021. You had to do takeout. That's limited commerce. You can qualify for the credit. If you had a business that everyone used to come in to do it, you have to go virtual. That's limiting your commerce. So you can qualify for that credit. We are working with a company that's a group of lawyers. We're still doing our due diligence on them. So if you are looking to do this credit, we will refer you to those lawyers, because we feel more comfortable with you going with someone that knows the legalese behind it. Because I've gotten calls, I know you've gotten calls where people have went with these companies that said they can do it, but then the IRS wants their money back, or the IRS says the information was incorrect. And you don't want that. You know, you're a small business owner, you don't want to get hit with that. But that credit still exists for small business owners.
And it's until 2024.
2024 for 2021 and 2020.
No, for 2020.
So 2024 for 2020 and 2025 for 2021. So you have time to amend these returns. It's not running out. So if people are pushing you to do it, you still have time. Once again, if you are a small business owner, you had W-2 employees, and you were affected, either your income went down or you had what we call limited commerce, give us a call or an email, and we will refer you over to those lawyers that can take care of that. The next thing for small business owners is a 1099-K. So beginning in 2021, individuals were supposed to start, 2023 now when we file it, but get a 1099-K if you had income of $600 or more from doing sales on a sales platform or getting money through Cash App, Vimeo, PayPal. If you were getting money through those different channels, there is going to be a 1099-K. And this is something that we were really worried about because, and I think a lot of people were worried about it, and they reached out to their congressmen, they reached out to anyone in the government official and asked them to stop it, and they actually paused this. So the 1099-K for the $600 has been paused for 2022, and they're going to look at it again when we file our taxes for 2023 and 2024. But one thing I would point out is, if you think about it logically, the government made these large corporations retool their data mining to look for individuals who are in a threshold of $600. And then in December, they said, oh, don't worry about it. We're not going to do it. We don't know if these companies are still going to issue a 1099-K. So if you feel you're going to be affected by it, I would urge you to wait a little bit before we file the return, because once again, if that 1099-K comes and we have to amend, you have to prove your expenses. You have to do some form of bookkeeping. We have to send it with the amended return. The government just doesn't believe what you say. The burden of proof is on you. You got to show that the glove doesn't fit. So I would say, if you are a person that feels that you may get this, wait. I'm actually doing a tax court case with a client that was in a community where they call it box hand or susu, but basically each person would give $500 or $100 every month, and then one person would get that $500, and then the next month everyone puts $100 in, and another person gets it. Unfortunately, she was doing it through Cash App, and she had a 1099-K. And this was in 2020. So we know that this may happen to other individuals. So we definitely want you to take that into consideration if you're a small business owner. One thing to note, Zelle is not on that list. Zelle is like a transferring tool between banks. Bank of America, Chase, TD Bank, who else? I think who else? PNC.
Yeah.
They all came together and made this Zelle system. It does not get reported to the IRS. I'm not saying you don't report the income if it's still business income. I'm just saying it doesn't get reported. So if you are doing anything like you're giving money to a teacher's fund, or you're doing anything like that box hand we were talking about at Susu, a Zelle will be your best bet. Another thing that changed for businesses, the mileage rate, the miles that you drive. For the first 6 months of 2022, it's 58.5 cents a mile. For the last 6 months, it's 62.5 cents a mile. So this is good for realtors, insurance brokers, home-based businesses. We're going to know that. So all you need to do is provide us with the miles that you drove for business. If you were dropping off things for a client, if you're going to client meetings, all those miles, if you're going to Staples, Home Depot, let us know those miles, and we will be able to get that deduction. The Anchor program. This is a beautiful program. I really love it. The Anchor program has been extended. If you saw one of our videos that we had in, I think, October, the deadline was December 30th, 2022. The state of New Jersey has extended that deadline to February 28th, 2023. So if you have not applied for the Anchor program, we would urge you to do it. If you are a homeowner, there is an ID and PIN that you'd have to get. If you go to our website and go into client tools under education, you can get that phone number. But this Anchor program is replacing the homestead benefit. It's open to residents who either rented or owned a property in 2019, as of October. This is a great program. When we do your return, if you're a New Jersey-based client, we ask you how much rent you paid. This helps out. Now, everything has two sides. If you're renting out your home, best believe your tenant's going to use that. So it would be in your best interest to let us know that you have a rental property also, because the states are going to be looking at that too. You must apply either by online or by mail or phone to secure this tax relief, but the extension is great.
The age, 65.
65, what are you talking about?
Well, the
That's a senior freeze.
Oh, the senior freeze, right?
And that's confusing. I think that's a good point.
Yeah.
So we were getting a lot of calls about, the age. So senior freeze is separate from this. You still can get your senior freeze and get your homestead benefit. So that's a good point that you kind of brought up. So on our website, we have forms that will help you file the tax return and make it smoother. The annual client data form, personal expense worksheet, rental property worksheet, small business worksheet. So all those forms help you. They're PDF forms. You can fill them out. You can print them out. You come into the office and get them. But we need you to really fill out these forms because they help us a great deal in processing your return in a timely fashion. If you go to our website and you click client tools right there, it will lead you to this where you would see all the forms. You can click on those forms. They have already been updated. So they are ready for the 2022 tax season, and you can use those forms. So there was a crazy hacking that went on. It sounds weird now that you say it, like there's a company that you could send all your passwords to and they will keep it safe. But at the time it sounded like a great thing. But
stop. But why would you want to send all your passwords?
There's so many.
But why would you want to send all your passwords to one place for safekeeping? It's like keeping your eggs in one basket.
I mean,
it doesn't make sense.
It doesn't make sense. Yeah, it doesn't make sense. But these guys were hacked, and LastPass is one of the biggest company. So I've gotten calls and I've heard about stories where people's bank accounts have been drained, credit cards have been opened. So this LastPass has made us change some things too. We have a new and improved portal. You can send and receive data safely. It has more data encryption. It's stronger. So the old portal, we're no longer using that. You have to request to be put onto this new portal if you're going to be sending documents. I know some people are still going to email. That's up to you. But when we send you documents, we're going to either send it to you in the portal or redact all the information because your tax return has so much information on it. We know your name, your address, your social, we know your children. You can kind of figure out your year of birth. So there's so much information on there. We are using this new portal to help us. Do not use the old portal. We're going to send out a separate email letting people know about this if they didn't make this webinar. And then if you need to go, if you're a portal user, call the office on Monday or send us an email and ask to be sent a new request, and we'll send you a new one. There's going to be 2 emails when you get the portal. One email saying welcome to the portal, and a second email that would look like this saying you have a temporary password. Your email address is your username. You use this temporary password to sign in, then you can change your password. It has way more security features than the past portal. Things will still disappear off the portal. I know a lot of people had issues where the items would disappear and they would say, hey, you put something on the portal. I went up there. I don't see it anymore. It's a security protocol. It makes it disappear after, I think, 30 days?
30 days.
30 days. It disappears off the portal. So you have to download it. But you have the ability to click multi-factor authentication. So the portal has way more security, and that's what we want to do is secure you as much as possible. Had a question?
No, I'm
Or
just
later?
yeah.
So planning tips. We talked about business, choosing the type of entity for you for your ventures. You can talk to us. More than likely, we're going to tell you the LLC is going to be your best bet. It's one of the best entities to create. The only time we would say corporation is if you want to raise capital or you don't want the income showing on your personal return at all, and you understand you'll pay a little bit more taxes. That's the only time we'll probably say that. But the LLC is a beautiful entity because it's a chameleon entity. It could be a sole proprietorship. You can add a person. It could be a partnership. You can file an election to be an S corporation. You can file an election to be a C corporation. You can use it as a non-for-profit, which I don't recommend. You can use it in a trust. It can be anything it wants to be. So choosing the type of business entity is really important. And we're going to talk about that later. Charitable giving, estate planning. Give us a call throughout the year. There's some clients that call us all throughout the year, ask us questions, and they're the ones that are prepared for those tax seasons that are coming up. Planning opportunities, we will evaluate a lot of things. Just reach out to us. We're here all year round. We do not close. We're always busy. Anytime someone calls me and says, "Are you busy?" I say, "Yeah, I am busy. I'm always busy, but I can still talk." Because you'll know when I can't talk because I'll probably be with a client or something like that, or you'll be with a client. But we're always here. Just ask us the questions. A closed mouth don't get fed. So you need to just reach out to us. Life is short. Pay less taxes is something that we have filed with the trademark. We are going to get this trademark. It's going to be one of our mottos that we're going to say. And it's true. After COVID, we realized life is really short. And your main goal in that is to live your life to the fullest. And one of the things is pay less taxes. Why would you want to pay more taxes if you don't legally have to? Because when you pass away, taxes still exist. So we have some other services that we're doing in 2022 and beyond. One of the things that we've created is a platform to help you create an LLC called New Jersey LLC Now or NJ LLC Now. Think about it as like a LegalZoom or a Zen Business. We ask you 5 simple questions and we'll create that LLC. And that LLC, the cost for it is lower than what we would charge because we usually charge $650, and that includes the state fee. On this website is about $475, which also includes the state fee. So we are doing more things moving forward into the future to help our clients and other clients really get further into the year. We have the book Pocket Advisors that I wrote for another CPA for helping real estate individuals. We have another website called WOMA that's coming up. We're going to be giving a lot of knowledge in ebooks. So we're trying our best to give you as much as possible and the other services. And that's it. I know we made it right there on the dot. If there's any questions, we have the chat open.
Yeah, they have one question on the Anchor program, and it was asking if you have rental property, if it qualifies, or multi-homes. But the key for the Anchor program is your principal residence. You could only get it on your principal residence, no other property.
Yeah, but I would say you are correct. You can only get it on your principal residence. But if you have a rental property that is your principal residence, you can only take a portion of it.
Yes.
So